Hello traders, it's Victor from TRADEPRO Academy. I hope everyone is doing well. And in today's video, what we're going to be talking about is options technical analysis. So throughout this video, what I'm going to be doing is explaining to you guys the basics of options technical analysis so that you can read a chart on any stock or index of your choosing. What you have to understand when you're going through this is that, yeah, you can find great levels, you can find great areas and use specific tools, but at the same time, you have to understand that the options pricing themselves are very time sensitive and also Greek sensitive. There's a lot more moving parts. So for example, in the underlying, if you get a $4 move up, it's not necessary that on the option, you're gonna get a $4 move on the contract, right? You have to understand that as you're going through this technical analysis. But throughout this video, what we're going to be talking about is different trends, how to identify trends, how those trends break and how they form and how they continue, along with a few very simple technical analysis approaches that revolve around volume. Now, whatever you see in this video can be interchangeable from day trading to swing trading, and we're going to talk about both aspects. I want you guys to smash that like button, smash that subscribe button, ring that little bell to notify you when we do go live. We've finally made it to the screens over here, and we're going to be talking about a few different things, right? When we talk about how we look at technical analysis the right way, especially when trading options, we have to understand how we can read price action and then focus on technical analysis. There's a few main topics that I do want to cover, and we're going to go from basic to a little more advanced throughout this video. I'm going to be talking about the most basic thing first, right? We have to understand what trends are, how trends shape up. When we understand that, we can take it a step further and start to look for areas of interest, right? Support and resistance areas, demand areas we can trade off of, right? We take it a step further and we start adding volume analysis to some of these areas, right? When we start talking about volume analysis, we can go even further. When we take it a step further, we can talk about the actual multi-time frame analysis. And then going even further, we can look at options charts. And then even further, we can take a look at other indicators that you might see on the screen. You might see in other aspects, right? I'll introduce some of the other indicators that I do like to look at. And I'm telling you right now, there's not going to be much. It's going to be a very, very simple technical analysis approach that I've found that works for years now and is very, very effective. So let's start from the beginning when we talk about this technical analysis and price action on options, doing it the right way, doing it the smart way here. Now, step number one, we have to understand the basics of price action, right? Price action is derived from market movement, which comes in trends, right? If we talk about trends, there are three main trends in the market, right? We got the bull trend, we got the bear trend, and we got the range trend. Starting off with the bull, it's the trend that we've exhibited more consistently than any other over the past few decades, if you will. And here we have an example of Goldman Sachs. Now, when we talk about a bull trend, we have something that creates higher highs and higher lows, right? Higher highs and higher lows, higher highs and higher lows, until at some point we fail to do so, right? We no longer have a higher high in this scenario, right? And we no longer have a higher low in this scenario. So the bull trend will continue to exist as long as these criteria are met, right? Higher high and higher lows. Now, there are a few things that can actually stall the bull trend and actually turn it around that we have to note. Number one, right, we have to understand that each higher low, right, can be respected as the final step to the continuation of the bull trend. Meaning that if the higher low turns into an equal low on the next move, right, just as this one did, it's still considered in the bull trend, right? There we go, continuation. Now, should this area be broken, that is when we get a turning point. Now, another turning point is going to be if we fail to make a higher high. No more higher highs. We're going to have to watch the prior higher low, which is somewhere here. Can we print an equal low to that area, right? These two in tandem, if they break, that is going to be the reversal of that trend, as we can see very clearly here, right? Higher high, higher low, higher high, higher low, right? Higher high, higher low, equal low, higher high, right? Higher low, about equal high, maybe a bit higher high in this scenario. We draw the line here. We start failing a little, right? Just a little head fake is enough to tell us that this thing's kind of over, but we get a lower high right here, and we become very suspicious of this level. Gap down officially ends the bull. And then we can either turn into one of two things, a range or a downside market. In this case, introducing part two, the bear trend, which is going to be lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and then eventually what happens? Very, very similar to the bull trend. As long as we can continue this pattern, we are going to see the downward move. Now, same thing, right? If we create a equal high, right? If we create an equal high, this is the lower high in this scenario, sorry. So this is the lower high right here. If we create an equal high, we still have the chance to create a lower low and continue this move. Now you can see this doesn't happen here. We also have an equal low in this area, which is a little worrisome. If we have a higher low mixed with a higher high, we can identify that the break of that bear has started, and we can look for a next potential move. And then finally, we have the range trade. The range trade, equal highs and equal lows, right? Very self-explanatory. We break out to the upside, we'll continue the bull. We break out to the downside, we'll continue the bear. So very simply put there, we have to understand the basis of these trends and the mechanics. Now, no matter what kind of time frame you look at, you can find these basic maneuvers and these basic trends. So another thing to add to our price action out of all of this, right? Understanding the trends, understanding the directionality, we can take it a step further and start drawing our support resistance areas. Now we can draw them as support resistance based on peaks and troughs and just different areas of inflection. We can also base them on supply and demand, right? Supply and demand zones where the downward move actually starts as supply. So something like this, right? That's going to be a big supply zone, or demand where the actual upward move might start, which would be somewhere here, right? That's going to be a huge demand zone. Or we can very simply put our areas as massive areas of inflection, right? So if we just draw this very simply, this is a huge area of inflection, right? These are massive areas of inflection, right? Multiple tests of an area becomes a big support resistance area, right? We can draw these anywhere, right? We can slap them down wherever we have these massive points of inflection where prices hold multiple tests, right? You can see a lot of these areas. Now, this is one way to do it. This is one way to draw these support resistance areas that I know a lot of people do. However, when we're talking about price action technical analysis, if we want to do it a more concise way, if we want to do it a way where we can factor in volume, which is a very, very important aspect of how markets actually move, we can introduce the volume profile. Now, the volume profile is good for many things. It's good for direction. It's good for identifying levels. It's good for keeping you on side of a move. And we've done countless volume profile videos, so this is not going to be one of those massive breakdowns of the volume profile, but instead, right, we're looking at a daily chart here on the on Goldman Sachs, right? Let's just get rid of these drawings. We're looking at a daily chart here on Goldman Sachs, and you can see we have a volume profile here to the right-hand side. This volume profile is what we call a visible range on TradingView. Now, this visible range, whatever you look at on the chart, right, whatever you look at on the screen is going to show you that volume profile. Now, with volume profiles, we have a few different aspects to keep in mind, right? I'm going to write these down very quickly. We have a point of control, which is the POC. We have a value area. We have a value area high. We have a value area low. We also have a low volume node. We have a high volume node, right? And we also have ledges and distributions. Can't write that fast. Damn it. Distributions. We also have ledges and distributions. So if we number these 1, 2, 3, 4, and 5, we have 5 general areas on the volume profile. Now, all these aspects can be taken on a larger scale and presented into a intraday chart, right? Something for day trading, swing trading, or whatever the case may be. The point of the volume profile is to be able to identify key areas of inflection, key areas of movement, right? And support and resistance areas, right? Based on distribution theory. Now, if we take a look at the POC, the point of control, quickly is going to be the largest level of volume that's traded. You can see denoted by this red line. This is an area of attraction generally for the market because market likes to move to high volume. The value area is going to be this darker, or I wouldn't say darker, I don't know, lighter shade You can see it's 70% of the volume of the first standard deviation. This is where the majority of volume likes to hang out. This is outside of the value area, the shaded area, which is 30%, right? It could be at the bottom, it could be at the top. And the value area is what we generally consider balance. Now, it's not only that we consider balance. We consider these distributions balance. These distributions are made up of multiple high volume nodes that stack together, and on either end of the distribution is a low volume node that makes the distribution drop off into low volume. These ledges or shelves, volume profile shelves, are going to be the top and the bottom of the distribution, and these ledges or shelves are going to be the main constituents for our support resistance levels, right? They do, for me, a better job than finding aggressive peaks, demand supply zones, all that stuff. A value area high and low is just the area that sandwiches the value area from the top and the bottom. And these are generally good support resistances as well. Now, the thing with the visible range is that it changes, right? So obviously, the distributions will stay fairly consistent, but you have to keep in mind when you move it around, it's going to change. So if you look at a yearly chart, for example, right, you're going to have a specific distribution. If you look at a 5-year chart, you're going to have a specific distribution, whatever the case may be, right? So just keep that in mind when you're drawing your levels and when you're zooming in and out of this chart. The levels are going to stay fairly consistent if you look at these large distribution blocks naturally, but just keep that in mind as you're going through this and your technical analysis. So let's just do that. We're going to identify the ledges of this distribution, right? This is the ledge of this distribution. This is the bottom ledge somewhere here. Now, what you could do is you can wiggle it around a little, right? Just in case you want to capture some of the exact lows if the distribution is that close, or some of the exact highs if the distribution is that close. You can see there's ledges that you can identify pretty much anywhere, right? This is the start of a distribution. Don't mind these weirdly drawn levels here, if you will. You can see the top of this distribution block here. Naturally, this is going to be a very, very thick ledge. Let's draw it there, right? You can draw another very thick ledge that sticks out like a sore thumb over there. There's not much here. You can find a defined ledge naturally at this low, maybe a little higher. And then you have a very distinct ledge right here. I want to just find the area where the high volume node of the distribution block drops off the most into the low volume node. So the difference between this high volume node and this high volume node isn't that large, but the difference between this high volume node and this low volume node, right, is a very large difference. That's going to be our ledge. That's going to be the key area that we'd be looking for, right? There's not too much in this area. Even if we zoom in, what kind of distribution can be created here, right? There's not really that much that really interests us. You can see it's very blocky here. So just keep that in mind. Now, why these areas are important, and this distribution theory is important, especially here on this example with Goldman Sachs, is that when you enter a distribution block, right, the typical practice is that we look for the opposing edge of that distribution block, right? Ledges on the distribution block are going to be the gatekeepers for price to stay within balance, because each distribution block is considered a balanced area. So when you enter a distribution, you want to see if price can go to the other end of that distribution, right? Sometimes it exceeds it, and that becomes an imbalanced market where we would look for the next distribution block, right? Now, when you enter the distribution again, you look for the opposite end of that distribution that acts as a support zone, and then the other end acts as a resistance, right? And then you get that pop down. We're at the lows of the distribution again. If price escapes the distribution on Goldman Sachs here, we become imbalanced, and there is a lot of room to move into the next ledge, which is somewhere around 300, and then realistically the target would be the yearly lows, right? This is the power and importance of these distributions, right? They're very effective when you talk about swing trading and these swing trade ideas. Let's take a look at Apple, for example. Apple's got a few distributions. They may not be as clear naturally, but they work well regardless. You can see right here, massive distribution ledge, obviously at the 151 area. You can see that clear as day, but some of them that aren't that clear, right? You can see there's a distribution here. There's a lower volume area here. There's a distribution here, right? Somewhere like this. There's kind of a lower volume area. So when we get into these areas, right, you drop through this area, this would be considered lower volume, right? You come into the edge of that distribution, that differentiates the higher volume distribution and the lower volume distribution. There's some massive resistance for price to enter into the next larger volume distribution block, right? Very, very simple in that regard. So this is one of the main things that we identify in technical analysis, not only to draw levels, but to give us a very good insight on how the market should move, what the expectations of those moves are, and when they could happen as well. When we push a little more into volume analysis, we can look at the volume on the histogram down below, right? This histogram volume helps us identify what the strength in the moves are, the strength in the trend is. And naturally, I do like to relate it to some kind of moving average, right? You drop a moving average on it. You can use a 20-day moving average. It doesn't matter what kind of moving average you use. Well, kind of does. Maybe like a 9 to 20 day, right? A 9 is very, very close to price, you'll see, right? So maybe something like a 20, a 21 even. So we like to relate it to an average, right? We like to relate volume to an average. When volume starts to dissipate on a strong move, for example, to the upside, right, you're going to see an eventual peak in volume. You can see how volume drops off at a certain point. Yes, around earnings, obviously there's going to be a lot of volume, but generally speaking, the volume on the up moves started to drop off. And eventually, right, we turned and we started to see larger volume on red days and smaller volume on green days, propelling us to look for that trend shift. Now, keep in mind, this volume coloring is arbitrary. There's no real such thing as like sell volume and buy volume on TradingView in this market, because you have to, for each buyer, you have to have a seller of those shares, right? You can't just sell them into the abyss and there's more selling volume than there's buying volume. It's just not the way that it works. You can just see that the red volume is for red days. The green volume is for green days. You can change the volume however you like. You can make it white. You can make it all black. It doesn't matter necessarily. But the point being here with volume is that you're watching general trends, especially in distribution blocks, how they shape up and how volume reacts to those key levels, right? If you're moving on the way up and volume starts to dissipate a little more and you're starting to see that red days are getting better volume as you drop away from a big distribution block into a lower one, you've now identified around 170 or so. Oops, it's not 170 at all. Around 170 or so, you have a massive resistance. Not only is it a ledge that will stop price from getting into the distribution block, but you've also seen that volume on the way down is thicker than any volume on the way up. So what you're doing is you're looking for that rejection into that area to look for the 165, the bottom end of that distribution before we get into the next distribution block. Then that opens up the case for the 160. Through the 160, that opens up the case for the 151 to 152, right? And again, vice versa. You start seeing buy volume that shapes up here. We're holding the distribution lows. What could happen, right? If we get a very nice pop into the top of this distribution block, they fail, so on and so forth. So with this understanding, with volume, all these volume principles, we can take technical analysis to yet another step further, right? We can look at multiple time frame analysis. Now, this is effective whether you're swinging, whether you're day trading. It doesn't matter what the case is, but when you look at multiple time frame analysis, you can get a larger and better perspective of how the market is shaping up and what levels are important, what volume looks good, how the intraday moves on volume had occurred, right? And it's pretty effective. When you're looking at a overall swing basis, right, you can look at a daily chart, a weekly chart to get your levels. Then you can drop down to an hourly. An hourly presents us with candlesticks, right? Certain candlesticks and volume and also closes. When we get hourly closes at key levels with aggressive candlesticks, for example, large wicked candlesticks, right? You can see these large wick candlesticks with very aggressive volume. These are things that you want to notice for the multiple time frame analysis. If you're swinging, right, an hourly chart will present those kinds of opportunities. Massive wick here, right? Pre-market on this hourly closes. We come back, we get another strong volume red candle on the hourly that closed at this resistance. We get another strong one with strong volume that wicks up here. You're getting multiple tests of this 170 region with heavy volume at a distribution ledge, telling you that there could be a little more downside. When you get into a distribution support zone, right, and you're looking at hourly closes on green candles, look at this green candle on September 6th, 10 a.m., right? The low of the candle, somewhere 154. Massive spike, very strong wick with a very thick volume block, right? 154s, pretty solid hourly close. Maybe you wait for a secondary one to get that move. But even if you're getting in, you're taking very little heat. And even this candle, right? The volume is fairly thick. It's a fairly strong red candle, but you take a look at this green candle that closes, next few green candles that close, right into the end of the day. Is this candle that big at this area? No, not necessarily, but the volume is aggressively thick. So again, 154 proves to be a match for that extension back to the upswing, right at the lows of a distribution block. If you're talking about multi-time frame analysis on a day trading aspect, right, you can take a look at SPY, for example, and you can take a look at an hourly and a 15-minute chart to really get your levels. You can see where these distribution blocks really shape up. You have a key level very defined at about 401, right? You have another key level sitting about like 399. You have another key level sitting about this 395, right? That presents us with those opportunities, right? And again, on a 15-minute chart, you might not be doing your active day trading. You might be doing it on a 5-minute chart, but the 15-minute chart helps you identify these intraday levels that you can trade off of, these very, very key distribution block levels. And again, same thing with the volume. 15, 30-minute candle for day trading, right? You close that at that area, you're going to get a potential opportunity for a nice little day trade throughout the day to reject those areas. So keep that in mind, right? 15-minute candle, what happens here? Very decent volume, nice close. September 6th on the bull side, right around that like 389. You're getting the same thing here. Very nice close in and around that area. Maybe you're looking for a little pop off that 390. You get a pretty successful day trade that runs into 398 into a single day, right? So keep that in mind. Obviously, you could be trading off a 5-minute chart, and these 15-minute charts could help you. The multi-time frame analysis is great for that. Now, if we're talking about options, we obviously have to talk about different options. We have to talk about how options play a role in these areas, right? What options do. And this is the technical analysis portion of options. You can also look at options from a general technical analysis point on the options contracts themselves. Right now, this isn't highly recommended, obviously, because options contracts, they have different pricing based on different criteria. However, it can be an area of interest, right? Because when you know what the price of an option was at a certain level, you can kind of assume if it's a shorter term option that it might be a little cheaper at that level the next time again, right? So technical analysis on an options chart might be something that you could be interested in, but I'm telling you right now, this is just one of those things to take a look at, right? Whenever you're placing stops, whenever you're doing something like that. But it's one of those things that it's not going to correlate one-to-one with the actual technical analysis on an individual underlying chart itself, because when SPY moves up 5 points, that doesn't mean the options contract's going to move up 5 points. Just keep that in mind, because there's other criteria that affect that. But it's something that you could consider. Now, with technical analysis, we've mainly broken down trends, drawing levels, volume profile, and volume analysis, right? And also multiple time frames and candlesticks to a certain extent. There's other aspects that you could use, right? For day trading, for example, there's something that I like to use. It's called the advanced decline, right? On TradingView, it's called ADVDEC.US. What this tells us is what portion of the market is advancing versus declining. It could give you a very strong understanding of what the trend throughout the day might be on a day trade basis, especially if you're trading SPY and triple Qs, the indices. So you can see, for example, yesterday we started off really weak and dropped off, and stocks remained in the sell zone pretty much all day with a few oscillations, but overall we remained very, very weak. If you're at negative 6,000, you're at negative almost 7,000. That's pretty much all the stocks in the world declining at the same time. This can help you understand where there could be inflection points, what the oscillation might be and what the general trend may be. The general trend is to the downside if you're at negative 5,000, negative 6,000, right? There's no surprise there. But you might be able to find inflection points on this advanced decline. This is one of the main tools that I do like for day trading. Now, if you want a specific video on this, you can just drop a comment down below. We'd be happy to oblige. When we're swing trading, right, I want to understand what the market breadth is. R3TW helps us understand what the market breadth of the market is, right, on 3,000 stocks. How many stocks are above their 20-day averages? And there are two areas. We've done a video on this, so go check it out. An oversold and an overbought area. This is great for swing trading, especially for swing trading SPY and triple Qs, right? When it's oversold, we are looking for areas. Obviously, from a technical perspective, it has to make sense. We're looking for areas to buy puts on for a few months out. When it's overbought, we're looking for areas to buy calls on for a few months out or a few weeks out. So keep that in mind. We've done a video on this, so you can go and check it out. There's a few other things like the McClellan oscillators. There's a lot of other indicators and technicals that you can put out there for your day trading or swing trading. However, the main components that I really, really like and do abide to, especially when options trading, is going to be the general trends and the overall volume profiles. There's other things like moving averages and stuff, but they're very, very tertiary. They're so far behind the curve that we don't really consider them as a main aspect. You would need trends for those to shape up. If you have a trend, then you can follow moving averages, right? You can follow moving averages like a 20-day on a day trading perspective. However, I don't like to leave those in. I much more prefer understanding how volume profiles work, how general trends work, right? How these key inflection points work along with volume. So if you guys enjoyed this video, stick around for the outro. We might have something there for you, and we'll see you guys on the screen. If you guys enjoyed that very simple form of technical analysis that guides you through different trends, volume analysis, and a few other things. You can apply these to day trading and swing trading, and I'm going to be dropping more videos on different options tools that can really help you identify how you can trade options the correct way. So if you guys enjoyed this video, smash that subscribe button, hit that like button, and we'll see you guys in our upcoming videos.